Welcome to our video on calculating the debt-to-equity ratio. The debt-to-equity ratio measures a company's financial leverage. To calculate it, divide total debt by total equity. Total debt includes all liabilities, like loans and bonds. Total equity includes common stock, preferred stock, and retained earnings. Let's walk through an example using Company XYZ's financials. Company XYZ has $500,000 in total debt and $1 million in total equity. Plugging these numbers into the formula, we get a debt-to-equity ratio of 0.5. This means that for every dollar of equity, there's 50 cents of debt. A higher ratio indicates higher financial risk. Now, let's look at another example with Company ABC. Company ABC has $700,000 in total debt and $300,000 in total equity. Calculating, we find a debt-to-equity ratio of 2.33. This suggests a riskier financial position compared to Company XYZ. Understanding this ratio is crucial for investors and creditors. It helps assess a company's ability to meet its financial obligations. Different industries may have different typical debt-to-equity ratios. It's important to compare ratios within the same industry. Using this ratio, stakeholders can make more informed decisions. In conclusion, the debt-to-equity ratio is a key financial metric. Thank you for watching, and stay tuned for more finance tutorials.